This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It's a great pleasure to have George Gammon back on the show. He is a real estate investor, an investor in all kinds of things, and a fantastic macroeconomics educator. It's always great to have him on the show. George, welcome back. How are you?
Hey, Jason, thanks for having me.
It's good to have you. And you are coming to us from Billionaires Row in Saint Barth's, right?
That's right. That's right. I tell people that I'm the poorest person here by a mile. Yeah. When I first got to the island, I looked around and I said, my goodness, I need a Saint Bart's stimulus check somehow.
I don't think you're going to get one there.
No, not going to get one here, that's for sure. But it's a beautiful place. And I came here just because I didn't want to deal with any lockdowns, and the restaurants are open, the gyms are open. I'm going to go to the gym after we talk. And it's nice to just have some sense of normalcy right now in a very crazy world.
Are there any cases there, or is it just totally clear? Is there any precaution there at all, or is it just normal living?
There are some precautions. When you go to the grocery store, they make you wear a mask. Some restaurants require that you wear a mask when you're walking to the bathroom, that crazy stuff. It's kind of weird because the French government has a little bit of say, but the people here, for the most part, really don't like the French government, and they just try to kind of ignore them. But technically, they're supposed to give a restaurant a ticket if the people aren't wearing a mask to the table, but very few restaurants even acknowledge those rules. So it's the main thing is you got to wear a mask when you're going to the grocery store. Other than that, you're pretty much good to go.
Pretty good. How did Saint Bart's, and I don't know if you've studied it much. I know you're there. You've been there maybe, a month and a half now or something. But how did Saint Bart's become this sort of, really high-end Caribbean destination? I mean, I never hear about it as a tax haven or an asset protection haven. I hear more about, Cayman or Nevis in that regard, and certainly other places around the world too, like Jersey, et cetera. But why St. Bart's?
Well, I think for the Europeans and the French, it is a tax haven. It's very similar to Monaco.
Okay.
It's just Monaco in the Caribbean, basically.
Okay.
I think the catalyst was Rockefeller. Rockefeller built a huge house here that's over by this beach where I go snorkeling. I think it's been abandoned for several decades, but it's still there. And he was the first person to kind of make it popular, I guess, with kind of that crowd. Since it's a very little island, there's maybe 9,000 people here. The people are quite literally the most pleasant group of people I've ever met in my life. They're not just nice, they're very courteous and just very welcoming as well. And I think that combined with it's very nice. I mean, a lot of the Caribbean islands, you go downtown and it's very written down, and it's not
terrible.
Yeah. I mean, the beaches are great and the oceans are great, but you go to in town, you're like, man, this is not awesome.
It's a slum in a lot of those places. I mean, it really is a total slum, and a high crime and all kinds of problems.
Saint Bart's is the complete opposite. Not only is the downtown area just gorgeous, there's nothing here that you would consider a slum, and the crime is, for the most part, just non-existent, to the extent that, I mean, nobody here locks their doors. Nobody. And I mean, your car, when you go out to a restaurant, most people just leave the keys in the car. They just leave them in the ignition. When I went ocean swimming yesterday out to these cliffs where I go cliff diving, and I just left on the beach, I just left my briefcase just right on a rock with my laptop, with my phone, which has all my credit cards in it, with my keys. I didn't even think twice. Didn't even see twice.
Interesting.
Because it doesn't really exist here. So that combined with everything else. And then you've got a lot of celebrities that come here because they don't get hassled. I know a lot of, singers and artists and whatnot have gotten married here. And I know I heard a statistic the other day from a guy at a cocktail party that during New Year's, like some crazy number, like 90% of the super yachts in the entire world are here in Saint Bart's.
Wow.
New Year's. It's a very popular place. I won't name any names, but a mutual friend of ours has a property here that he rents out during the holiday season, which is the high season here.
Right. I know who you're talking about. Yeah.
Yeah. Well, we won't name any names because I don't want to throw out his numbers or anything, but he rents it out for 6 figures per week.
Wow.
Yeah, it's that type of place.
You sent me an image from your phone, a screenshot of a map with properties for lease or rent there. And I couldn't believe the prices. They were super expensive, but I'll bet you.
Just on Airbnb, I think that was.
Yeah. Prices were astronomical, but I'll bet you the rent to value ratios aren't very good because I bet you the value of those properties is just astronomical, even more so than the rents.
It still is. No, it still is. No, the RV ratios, you can get a good RV ratio here. The problem
that's amazing.
Yeah. I mean, who's got 20 million to drop on a property?
Right.
But believe it or not, I mean,
you mean a good RV ratio in favor of the tenant, right? Right. Not as a landlord. Oh, is it landlord?
Oh, yeah.
Oh, that's amazing on expensive properties. I wouldn't have thought. Yeah.
Yeah. As an example, if you know what you're doing, if you've got, let's say 7 million in a property, you can make $700,000 a year on that.
Yeah.
Net.
Well, you got to get 70,000 a month for 1% of 7 million, right? So,
you're getting 6 figures a week during the high season.
Yeah. Right. Well, that's vacation rentals too. So, more volatility potentially. But right now, given the fact that you don't have lockdowns there, it's an attractive place for wealthy people. So, that skews the thing too, but very interesting. Well, hey, the other very courteous place that I've been, and I think you've been there too, is Japan. And, you did a fantastic YouTube video recently and another one where you're talking to Peter Schiff and then you were talking about the Federal Reserve and what they don't want us to know and so forth. And I thought I'd like to ask you, because I talk about Japan quite a bit on my show. It's a really interesting economic story. They've been saddled with, what used to be called the lost decade, then it became the lost 2 decades, and now it's into the lost 3 decades. And then they had, Abenomics, which, many people have heard of, and they've got a real demographic disaster in that they're just not having kids and the population is aging, obviously. And in 70 to 100 years, if they don't have kids or immigration, Japan literally won't exist. You can't have a country if you don't have people, right? So, but it's fascinating because people have really downplayed Japan, saying that, look, their debt to GDP ratio is the highest in the modern world. It's 230% debt to GDP. And just to give people a reference point, and I haven't checked it lately, but I think even into all this craziness now, it's gotten worse, but the U.S. is around 100% or approaching 100% debt to GDP.
More than that.
Oh, it's more than that now. Okay.
Yeah, now we're running these $4+ trillion deficits. The U.S. deficit just this year will be the same as the total amount of debt accumulated from 1776 to 2000.
Yeah, I have to laugh at that. It's so absurd. It's so totally absurd. It's beyond. It's just beyond comprehension, frankly. So we'll talk about that. But, we were talking off air about Japan, and I'd just like you to touch on that for a moment, in that the debt to GDP ratio does not necessarily bode so badly for Japan as one might think, right?
Well, it hasn't caused hyperinflation.
Mm-hmm. The opposite, actually, right? Yeah.
Yeah, it's called it's caused mild deflation, which I think is when a country gets that over indebted. I think kind of just a very slow grind deflation like that is probably a best case scenario. If you look at history, when you get a debt problem, it's just, there's no easy way out of it. I mean, Dr. Lacey Hunt talks about this all the time. You either have to have austerity, or you've got to inflate away the debt, or unfortunately, sometimes the way to get out of it is a war. But there just is no easy way out. If you overconsume, If you consume more than you produce for a long period of time, at some point you've got to underconsume. Mm-hmm. That's just the way it works. There's no financial engineering that gets you around just a basic thought experiment. If you were stranded on an island and I always use the thought experiment that if you were stranded on an island with a suitcase full of $1 billion, are you rich? I don't think so, because there's no goods or services.
Right.
So anyway, going back to Japan, what most people see is they say, well, how come they haven't had inflation or hyperinflation? And therefore, if they've done quantitative easing, if they've done all these things for the past 3 decades or plus, why can't the United States do the same thing? And the United States could do the same thing, but there are no certainties. There are always probabilities. So you have to look at the facts and how the economies are set up and then weigh the probabilities for yourself. So there are dramatic differences. First and foremost is the savings rate in Japan is staggering. I mean, it's almost 30%. And so if you have your population saving that much money and not spending it into circulation, your velocity gets so low that I'm not going to say that it's hard to have inflation, but you're not going to get it as easily. And then most people would see inflation as the value of the currency going down in relationship to goods and services or to other currencies. And there's always a bid for the yen because they're a net exporter. Mm-hmm. So what happens is when you got two countries that are trading between one another, the one that is producing more stuff, more goods, and exporting those goods, they're going to have a trade surplus. And therefore, there's going to be more demand for those currencies from the countries who are buying their goods, right? Where the opposite is true. If you've got a trade surplus, then what you're doing is you're exporting more of your currency units. And therefore, at some time, if all else being equal, the value of those currency units relative to other countries is going to go down. The reason that hasn't happened with the United States is because obviously we're the world reserve currency and the world runs on dollars. And therefore there's a bid for these dollars to do business outside of the United States, regardless of what's happening with our domestic economy or how much goods and services or how little goods we're actually producing and exporting.
Yeah, the U.S. is in a pretty enviable position, at least for the time being. And you can really break a lot of rules when you're in the position the U.S. is in. You can defy gravity. The only question is for how long. I want to show you a chart real quick, George.
And also it distorts the economy. Most people don't really think that through. So I would argue that it massively distorts the economy as well. Mm-hmm. So going back to an interview with Lacey Hunt I want to give them props. Grant Williams, who's just a fantastic guy, just interviewed him for my channel, and Bill Fleckenstein did an interview called The End Game, or their podcast is called The End Game. This episode was Dr. Lacey Hunt, and they talk about a debt jubilee. Mm-hmm. And I think as a thought experiment, that's a great way for us to get our heads around what happens to an economy when you overconsume. It's not just the debt, like the Keynesians and the MMT people would say, well, if the Fed could just buy all of the treasuries, as an example, then on the asset side of the Fed's balance sheet, you'd have, let's say, 27 trillion in treasuries. And then on the liability side of the government's balance sheet, you'd have the same 27 trillion in treasuries. Well, okay, just click a button and erase it.
Right.
So everything's just like an NBA scoreboard, right?
Magic,
you just score from 100 all the way down to 0, and you just start all over again. Right. And the Fed keeps spending money, and the economy grows as a result of this government spending. But what's absent in that line of thinking is what has happened to the economy as a result of the government spending all that money in the first place. Mm-hmm. So as an example, with the United States, government spending now is over 50% of GDP, over 50%.
Absolutely insane.
Yeah, so half your economy is government spending, and we know government doesn't produce anything.
Right, yeah, they just...
especially on net balance.
Right,
yeah, so they're not producing anything. So 50% of this, so that doesn't go away, right? Mm-hmm. So even if they are able to start from 0 again, the only thing that happens is that gets worse. It goes from 50% to 60%.
Right.
So if the quote unquote, how rich an economy is based on the amount of goods and services that are actually being produced,
right,
and not the currency units that are just being
right,
printed, at some point it comes home to roost, regardless of whether you have a debt jubilee or not. Another great example would be all the zombie corporations
right,
in Japan. If Japan had a debt jubilee, those zombie corporations would still be there.
Yeah, no, that's all fascinating. Before you go on too much, I just shared my screen a moment ago, and I just want you to see this because it's sort of interesting, and it sort of goes to this like a whole dysfunctional system we have. If you look at the personal savings rate in the U.S., it's always been, fairly low. Americans are criticized for
keep in mind
not saving enough.
This is like the CPI as well.
Right. Yeah,
I've done the video on how they measure.
Of course, I don't deny that it's manipulated and
bogus.
And
you'll notice that they changed it. I think they changed it back in 2015, right around there, Jason. But prior, it was like 3-4%, and then it just hopped right up to 7%. That was because of the finagling of the numbers. So let's.
But they didn't change it this year. So the benchmark, relatively speaking, is all we're looking at. And it's just interesting to notice how much money people are saving when they're in lockdown, because they're not out spending money, right? So you see here, we're looking at February, March area right here, and it's hovering around, 7.7, 8%, something like that. And then the savings rate just skyrockets, and
Buzz Lightyear,
and to infinity and beyond. And, they're getting an extra $600, like paying them not to work. Right. And then you see as the lockdowns are lifted, the savings rate starts to plummet a little bit as people go out and they buy an RV. They buy a boat. They go out to some restaurants. They're not going on airplanes, but they're doing vacationing with RVs. Like RV sales are through the roof.
So is sporting goods because everyone's buying camping gear.
Yeah, right. So people are doing domestic vacations, right? So this is just kind of interesting. I just thought I'd share that.
Well, I think they're doing domestic vacations, and then they're also getting out of Dodge. Mm-hmm. I mean, I don't know if you saw what happened to like Rand Paul last night, and I mean, it's just bananas in urban areas in the United States right now, especially in blue states. I got a lot of buddies that are even in red states that have bought RVs, and they lived in kind of even suburban urban areas. And they're like, listen, I'm out. I can work from my computer. I'm going to go up to like Sholo, Arizona, as an example. Right. And I'm just going to sit here in a campsite with Wi-Fi and
when we have 5G, as long as you have a tower close to you, those towers need to be plentiful and close to you. And now there's a whole bunch of theories about 5G and the health side effects I won't go into, but that will make internet just plentiful, mobile, super fast. Tell us though about this savings chart. What was the manipulation and when was it? 2015? Because, this goes back that far. And by the way, this is from the St. Louis Fed, but just tell us about the manipulation. We talk about unemployment number manipulation a lot. You and I both do that. Obviously the CPI, consumer price index, inflation metrics manipulated massively, but what about the savings rate?
I'd have to go back and look at my notes. Mm-hmm. I don't know the year right off the top of my head. Okay. This is a video I probably did 4 or 5 months ago. Uh-huh. I remember with the manipulation of the rate, though, it had to do with the fact of how the IRS estimates what you're not paying them. Mm-hmm. Okay. And so it's just a completely obscure, like objective or subjective number. Uh-huh. And that when I read it, I'm like, I think it was the reason it didn't make any sense to me whatsoever is because it only calculated what people are not paying them, and it didn't calculate how much people are overpaying them. Okay. Yeah, which I would argue people overpay far more than they underpay. The IRS always says, if Americans paid the tax that they should, or people underpay by $500 billion a year or something like that. Mm-hmm. But all they're doing is they're looking at the people that underpay. They're not looking at it on net balance. They don't look at all the people who overpay because they don't want you to know about that. In fact, I talked to Robert Barts, who's a good buddy of mine. He was the lawyer for Alex Jones against Twitter. He's a free speech, constitutional lawyer. Right. He represented Wesley Snipes against the IRS and whatnot. Uh-huh. So he's got a lot of knowledge with these IRS cases. And, we talked about how many people actually overpay. And he's saying he went through some of these deductions that I've never even heard of. And I've been audited 5 times.
Wow.
I've never, as a business owner, as an entrepreneur, you have a better understanding as to what, especially as a real estate guy, as to what's deductible and not. And he was going down this list of things that I have never even heard of. So I can almost promise you that 90% of the people, especially if they're just going out there to H&R Block or using some sort of software program, that they're not taking all the deductions that they qualify for, not even close to it. So anyway.
Yeah, no, it's 70 some odd thousand pages of tax code, I guess, at last time I knew, and it's just super complicated. And there's so much manipulation. I mean, in 2006, I think it was, they stopped publishing M3. It's just a moving target to try and figure out the economy, because the powers that be want to just hide everything from the hoi polloi, us little people. But George, you did a fantastic video recently about the things the Fed, or really the powers that be in general, don't want us to know. Do you want to talk about that a little bit?
Yeah, well, three things. First was that you always hear that deflation is bad and it's the boogeyman. And I think it's actually good if you look at deflation in and of itself, especially if it's produced by free market forces, which if we had a free market capitalist society, we would see deflation, and it would be very healthy deflation, because entrepreneurs are out there producing goods and services, and they're trying to compete with one another, and they're doing it more efficiently, and they're producing things at lower prices. And that increases demand. That's really kind of the line in the sand. You got to ask yourself, is this type of deflation increasing demand, or is it decreasing demand? And that's where, most of the deflation that we have now, it's kind of a scary thing because of the amount of debt that we have in the system. But I would argue that that's like saying that, heroin isn't the problem. The problem is that XYZ person is addicted to the heroin. The heroin in and of itself isn't the issue. The next one was that inflation is good. We always hear that from the government, or the Fed especially, or central banks, that they have these inflation targets.
Right, 2%. We've all heard that. Yeah. And now that's of course a moving bogey as well. I don't know if you heard Powell's latest speech. Oh, that is earth shattering. I made a big deal about that on my podcast either yesterday or the day before, but this is a sea change potentially, folks. The Fed has just lifted all the constraints, and they've come out and said, we're not going to forecast and act in a forecasting or react to forecast. We're going to wait until we see it, and then we're going to change. And, that's like a giant oil tanker. It takes a long time to turn that big baby around. And if the Fed, if this is their new philosophy, then, that is pretty risky, I'd say, right?
They're always moving the target. It's nonsense. First, it's like, let's get up to 2%.
Yeah.
And then once they get up to 2%, they say, well, actually, it's got to average 2%, and we were under 2% for 10 years. So now we can run at 10%, and it doesn't matter because it'll just be an average. As though how that makes sense, I don't know.
Then they'll change the time frame they do the average over, or they'll take out a couple of years that are anomalies that they don't like, and make it a weighted average versus an average. So
exactly. Great. So this is just the next step in the long line of I don't want to call them lies, but just kind of this smoke and mirrors game that they're playing when they just won't admit that they, meaning the government, has to have inflation. It's the path of least resistance for a government that's 27 trillion in debt. And this debt is just going to be ever crushing them, as it increases with these deficits that we're seeing in COVID. But, so you hear that this inflation, this low type of inflation, is actually good. And then the third thing that I went over is who actually owns the Fed. And I focused on the New York Fed, and the usual suspects are there. The top three. I think it was Citi, J.P. Morgan, Goldman Sachs. But the next two, I think, would really shock a lot of people in the sense that it was HSBC and Deutsche Bank. So a lot of people, when I bring up, let's look at the Fed's P&L, not just their balance sheet, they say, oh, that's nonsense because they only get a 6% dividend, and everything that they make as far as profit from their, I don't want to call them investments, but we'll say their balance sheet goes right to the Treasury. And I'm like, maybe not. I mean, the Fed has a surplus account that they even admit to, that they have money in that's in excess of what they repatriate to the government and after the dividend. That's one. But then what most people aren't thinking about is, listen, just because they might not get billions and billions and billions and billions in distributions as owners, think about all the money that they're making or the profit they're making as a result of maybe being closer, having the ear of a Fed governor or being like a crony. Sure. Yeah. You know, I mean, 2008, it's a great example. You know, they get the bailouts from the government or the Fed. And now more recently, you know, we had the repo spike in September, and it goes up to 10%. I mean, if the Fed wouldn't have stepped in right there, I don't think people understand. I mean, we're done. The banking system is done. There's no way that you can have the dollar funding market operate with 10% interest rates. And so they come in, they basically bailed out the banks right there, in my opinion. And then you have what we saw in March. And it's not just now the Fed, now it's the government coming in with their stimulus and bailouts that are like a government put, is what I call it now. And that's bailing out the banks to a certain degree. But then you look at all the investment banks and they have record profits. And is it any surprise because they think there's a Fed put? And you know, I think you could argue that there could be, whether it's psychological or it's direct or implicit. But so their downside is capped, but their upside is almost limitless. So you look at the risk reward, and that's all benefiting the banks. So it's
socialism for the rich and the giant corporations. You know, it's
especially the big banks. Yeah. So that's kind of the three things that I outlined. But as far as the deflation example that I gave, it was the late 1800s, and we saw that. Everything, I think, went in the right direction. As an example, the average hours worked for the few positions that I saw went down pretty much across the United States. The wages went up. In some case, wages went up dramatically, like 50% just in the span of 10 years from 1890 to 1903. And so then you say, okay, that's a good thing. But keep in mind that from 1865 to the year 1900, we had almost 50% deflation. 50.
Post-Civil War era. Yeah.
Wow. Yeah. So, and gold standard, really. Yeah. So what you have is, 52 cents in 1900 could buy what $1 could buy in 1865. So you have the prices of goods and services going down, 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 while people's wages in nominal terms, not just real terms, but in nominal terms, are going up, 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 and up. And then you have GDP increasing dramatically. GDP from 1865 to 1900 went up by almost 100%. And that's in nominal terms. And people say, yeah, but the population increased. Right. Look at the per capita GDP. That went up as well in nominal terms. So, I mean, how can you... Well, that's a rhetorical question. You can't produce an environment that's better for the poor and middle class, where their lives improve more dramatically, than something where their wages are going up and the cost of what they buy daily is going down consistently, let's say at a 3% clip per annum. I mean, that is the best. Go ahead.
I was just going to say, could you attribute any of that deflation for that long period to the Industrial Revolution, though?
Oh, yeah.
I mean, that was...
Sure. I think most of it you could attribute to that. So that's the free market. That's what I was saying. When you have a normal not a normal, but a free market where it's very few regulations, where people can actually compete, and you have, Schumpeter's creative destruction that's actually allowed to take place, and you have all these things. You don't have manipulated interest rates. You have hard money. You have sound money. That is absolutely key. Then what happens is guys and gals like you and I go out there and we produce whatever we can produce to pursue our own self-interest, and we compete with one another. We're very competitive. I know you're competitive. I'm extremely competitive, and we're always going to try to gain market share. We're going to try to make more money. The way we do that is by producing a good or service that people value more than the money in their pocket. And so we're always trying to find better ways to do things. We're always trying to find ways to create new technologies to deliver our goods and services to the general public at a cheaper cost. And that benefits everybody. And as those prices go down and their wages stay the same and not go up, that increases demand. That doesn't decrease demand. Yeah. So it's the fact that we have an economy now that's based on debt, asset prices, and confidence. That's the reason why we could get a deflationary spiral that would be a bad thing, because people can't get debt, and they need the debt to further increase their consumption. So that's an example of demand going down because there's just no more debt, or there's not an expansion of debt. But that's not deflation's fault. That's the fault of the underlying economy.
Mm-hmm. So a lot of it, plays in whether there's inflation, deflation, whatever. And, you can divide it up between consumer prices and asset prices for sure. And, I know you have a lot to say about that and some great stuff there. These interest rates, George, are insane. I mean, it's just got to be a completely artificial market in the interest rates. Where do you think we're going? And interest rates are just notoriously hard to predict because, especially when you have policymakers intervening all the time.
Right.
Where do you think we're going with this interest rate stuff? And I'm sure you believe it's dysfunctional and causes a lot of malinvestment and such, and, people to do improper things that they wouldn't normally do. And obviously it hurts savers and usually older people. But, what are your thoughts about that? I just thought I'd throw a few things out there, give you something to chew on.
Well, let's think through the Fisher equation. Mm-hmm. And I'm not sure if you're familiar with the Fisher equation. Very, very simple, but it has a dramatic impact. So the Fisher equation is just, if my memory serves me right here, it is the real interest rates plus the rate of inflation would give us nominal rates. So you've got, let me write this down here. So we've got the real rates, real interest rates. Because there has to be a cost to the use of money, because when a lender loans the money, they have an opportunity cost because they can't use the money for something else. Thus the basis of interest rate, time value of money, et cetera, right? Yeah.
So that's fair. And then you take the real rate of inflation and you add it to that opportunity cost, and that should be the interest rate in my eyes.
Yes, that's correct. That's basically the Fisher equation. An easier way to look at the equation, I think, is it was the same equation, is if you take nominal rates minus inflation, that gives us the real rates. Everyone, that's pretty much common sense right there.
Mm-hmm, right.
So if the Fed pegs the rate at zero, so they peg Fed funds at zero, and let's say that we actually have deflation, that the economy, we have all this debt, and the economy is trying to get it out, it's trying to flush it out of the system. So as an economy, we're having deflation. Okay. Well, if they're pegging it at zero, they won't let it go negative. If we have let's say a -2 rate of deflation, well, what that's doing to the real rates is it's increasing them, right? And if we have increasingly high real interest rates, that makes it harder for people to borrow. That makes the money more expensive. So the only release valve for the government, if the Fisher equation is true, which it obviously is to allow the rates to go negative. So it's allow the Fed funds rate to go negative, and therefore that would allow real rates to go back to zero or to negative, where people could actually afford to take on more debt. You see? So my point is, the Fed's backed up into a corner where if, and I'm just saying if, the system stayed the same way as it is today, meaning that they had to abide by the Federal Reserve Act. And so that's a whole other topic. But what I'm talking about is them not being able to take bank reserves and inject it directly into the economy through just, let's say, a Fed coin and bring it to your app. So that's a whole other topic of conversation. And I think they'll go around the Federal Reserve Act. But if they abide by the way the system is set up now, let's say, the Fed would have no choice at some point than to take rates negative. They have to, just because of Fisher equation. Because if deflation is going down because of this over indebtedness, and I'm not just talking about consumer prices, I'm talking about assets as well. Mm-hmm. Then the real rate of interest, like we said, goes up and up and up and up. But if you have the real rate of interest going up while you have deflation, that just feeds on itself. And that creates a positive feedback loop that gets really, really ugly really fast. So they'd have to get rates further negative to opening up the affordability to increasing debt with consumers and businesses in the real economy. So,
and home buyers. Yeah.
Home buyers, everyone. Yeah. So that's kind of, I'd have people look at the Fisher equation if they're trying to figure out what's going to happen with interest rates moving forward. Now, then you'd have to handicap on top of that. What are the chances that the Fed circumnavigates the current system, especially based on what we've seen them do since repo and since March, where they pretty much abandoned every single thing that is written in the Federal Reserve Act. They're buying junk debt. And I've read the Federal Reserve Act, and I can promise you nowhere in the Federal Reserve Act does it say that the Fed can buy corporate debt or corporate junk debt for that matter. And obviously they're doing it. So if they get around that, then they can create inflation without having to rely on the commercial banking system. Because right now, the main way that they can get M2 to increase, meaning more currency units chasing the same amount of goods and services, is by the banks lending new money into existence.
Right.
By creating loans. Yep. So the deflationist argument is, well, the banks aren't lending and there's no consumer appetite for debt because we have these positive real rates, right? That's crushing the economy. And therefore there's no money that's being created. Money's being destroyed. And that's deflationary. That's basically the crux of their argument, right? But what they're not considering, they might be considering it, but they're giving it a low probability, where I would give it a high probability, is at some point the Fed will look at Japan. They'll look at the ECB, the Eurozone. They'll look at these negative rates and they'll say, listen, we cannot take rates negative here in the United States because we have the reserve currency and we have this infrastructure, meaning the bond market, that is completely reliant on rates being positive, at least at zero. Once it goes negative, it's not like the German Bund going negative or JGBs. It's a whole different
It's a whole different animal. I agree with you on that.
Yes, they're going to try to get around it.
Yeah, you probably have more to that thought, but I just didn't want to forget to ask you this because I think my viewers and listeners want to know George's opinion on this. We were talking a few minutes ago about the target rate of inflation, 2%. The Fed has publicly stated, that's their goal. That's relates to the Phillips curve and the relationship between inflation and unemployment rates. But there does seem like, I have a feeling you're going to disagree with this, but there seems like a valid argument you can make to have some inflation in the system as long as the highly manipulated GDP is increasing and the population is increasing. It seems like there's a logical argument to have some inflation that's relative to population and GDP increases. Does George Gammon think so? I have a feeling he's going to say no, but what do you think?
I don't see the upside for that.
Okay.
I guess the argument is the economy needs more money if it's growing.
Yeah, right. There's more people. There's a bigger economy.
More people. Yeah, but I just say that you just divide the currency units you have into a lower amount. So let's say we had dollars right now. Let's say we had $100 in the entire economy. And we're like, shoot, this is getting cumbersome. We don't have enough currency units to transact because I have to wait for that guy to sell his cow in order for me to have currency units to trade to this person.
Right.
It's being restricted, right? Well, I just say, okay, well, let's not increase the amount of dollars. Let's just create quarters. Let's create dimes. Let's create pennies. And that's how I get around that.
Yeah, right. All right. And it's interesting also that there's this giant coin shortage going on, which makes me suspicious that there's something behind that, either a digital currency on the way, which I think that's going to happen, obviously, at some point at least. China is certainly moving in that direction. Smart for them, bad for the people, though. Or just the fact that it's just too expensive, or there's going to be a lot of inflation in the system and those coins are going to be meaningless. I mean, why, it costs 1.6 cents to produce a penny. Like, how did we get here? This is just obvious that there's massive inflation in the system.
Yeah, and I think that's a great point. I think it goes back to what we were talking about with the Fisher equation and how the Fed has painted themselves into a corner where they have to take rates negative, but they can't take rates negative because it blows up the whole system.
Yeah.
So how do you get around that? Well, you ban cash And then what you do is you have, let's call it UBI or whatever, that's funded by
universal basic income.
Yeah. So it's funded by the Fed's balance sheet. So that's a direct way to get around the banks to inject more currency units into the real economy without the banks having to create more loans. Yeah. And so I think that's kind of going to be their rationale. Obviously, they're going to sell it as this is for your security, this is for your safety, this is for benefit.
It's to avoid terrorism, drug dealers, human trafficking.
The freedom dividend, right? It's the freedom dividend that you deserve as an American. So this freedom dividend is $2,000 a month. But in order to get it, you've just got to download the Freedom Dividend app on your phone, and then you're going to have a bank account with the Fed, just like JP Morgan, just like the TGA, the Treasury General account, just like the primary dealer banks. Jason Hartman, well, you might not because you probably opt out like I would, but average Joe, let's say, is going to download the app and they're going to have an account with the Fed. And the Fed is going to create new bank reserves, just like they do with JP Morgan when they do quantitative easing and they buy treasuries. And instead of the Fed buying assets from you, they're just going to simply increase the amount that's in your account by $1,000 with bank reserves.
And that'll be your UBI, your universal basic income right there. And then you go on the phone and you got to spend that money on the phone. And guess what? If they don't like you or you commit a crime or thought to have committed a crime, they'll just shut you off and you won't have any spending privacy at all. They'll know every unit you spend somewhere.
And where you spend it, how you spend it, how fast you spend it. And then if they don't see velocity increasing, what they'll do is they'll just reduce the amount of time that you have to spend your freedom dollars. Or
they'll put an expiration date on it to discourage saving.
That's right.
Unbelievable.
That's right. Yeah. I mean, they could say, okay, Jason, if you don't spend this $2,000 in 30 days,
it expires.
Poof, it's gone.
Just like your frequent flyer miles in your airline program or that gift card that you didn't use, Yeah. Really scary stuff, George. You think we're going there?
Yep. Yeah. I don't think they're going to have a way out. I mean, if you are under the assumption that the Fed has any level of intelligence in the 900 PhDs at the Fed, and that's debatable. But you can't, if you and I were at the Fed and they said, hey, Jason, George, we need to create inflation because we have to bail out the government. How are we going to do that? Well, what you and I would most likely do is we'd study Japan. We'd study the Eurozone. We'd figure out, okay, why didn't this work? Why hasn't Japan been able to get it? And then we'd sit there and we'd go over the obviously they have more access to more data than you and I do. Yeah. So if you and I can figure this out,
right?
I mean, they've got to be able to figure it out.
Oh, sure. Yeah.
And then so they're reporting to the powers that be, and they're saying, okay, this is why Japan didn't create inflation. Okay, how can we get around this? And the only answer is to get around the commercial banking system and get velocity up. And even that might not work. But that's kind of the Hail Mary. So if the only other option really is belt tightening and austerity. So if you think that, with politicians, especially in the United States, they're always going to take the path of least resistance.
Of course.
Always.
Yeah.
And so think about how politically palatable that would be for a politician to go out there to their constituents or to go on, Fox News or CNN or whatever and say, hey guys, you know what we need to do for the next 10 years is we just need to produce more than we consume.
Right.
And we need to tighten our belts and we need to go through the 1930s.
That's very old fashioned and nobody would do it nowadays.
Save money. And you guys need to live beneath your means.
Yeah.
You need to, your standard of living
needs to go down,
decrease dramatically for the next 10 years. Or what we can do is we can just give you money to spend every month. Which do you choose?
Yeah, obviously we all know what they're going to choose. Yeah, it's crazy. It really is. Well, George, just wrap this up for us. Are there any? I'm sure there are questions that I didn't ask you, of course, that maybe you just want to say anything. Wrap it up with some closing thoughts for our listeners and viewers, if you would.
Well, I always say that in today's time, you can be prepared or you're going to be a victim. And I think what we're talking about with not just inflation, deflation, everything that's going on in the Fed with money printing, quote unquote, you've got to look at hard assets. Mm-hmm. I mean, and I don't care whether you're a gold bug, silver, if you're a real estate guy or gal, you might, obviously you want some dry powder there in case we get, the stock market going down, you can take advantage of that. But you've got to have hard assets because you just don't know what they're going to do. And we know that it's to their benefit. They're incentivized to create not just inflation, but a lot of inflation.
Right. Yeah.
And therefore, you don't want to be on the other end of that if they're able to achieve it. So again, obviously you're the real estate guy, so I'd defer people to you. And I'd be very careful about the real estate as well. I mean, these urban areas, social unrest, I just don't think you want anything to do with that, especially, and we didn't talk about the wealth tax in California and all this nonsense. So you got to be very, very, very careful. But start considering hard assets right now. I also like commodities. And as you point out very well, and you have for over a decade, that all a house is just packaged commodities. Yeah. So I'd encourage people to not only understand this stuff, but to start figuring out how they can apply what we're talking about to their current portfolio or maybe their everyday lives when it comes to the urban areas and social unrest. That's pretty much what I'd end on.
Yeah. And George, I would agree with you. See, hard assets, I like real estate the best, or the commodities that make up the real estate, the copper wire, the steel, the glass, the lumber, the petroleum products, the concrete, et cetera, all the ingredients of a house. Those have intrinsic value, regardless of what any currency on earth is doing. Everybody just needs those intrinsically. They have their own value, regardless of being indexed to a currency like the dollar or the yen or the euro or whatever. So I agree with you there definitely, and stay away from the urban areas and stay away from politically left-leaning areas. Yeah. I think we can say with certainty that the left-leaning areas are literally becoming, to use a Trumpism, shitholes. And it's just my home state, the vast majority of my adult life, the Socialist Republic of California. It is so sad to see what is happening to that beautiful state. And they're just ruining it. I mean, the policymakers are just destroying that state, and especially the urban areas within the state. So, you look at San Francisco, you look at Los Angeles, where I grew up, especially bad there, but just the state in general. And, you look at New York, it's just unbelievable. I mean, I just cannot, there's just no excuse. And these mayors, these left-leaning mayors of these cities, they should be indicted for not protecting the property and the people that live there. That's their solemn duty, is to do that. And they've let this descend into a state of anarchy. I mean, these businesses are being ruined, lives are being ruined, people are being assaulted, killed, attacked. This is unbelievable that this is happening in the U.S.
Yeah, that's the best way to say it. And again, you can just ignore this. You can have cognitive dissonance. You can try to rationalize it. Yeah. But if
it's
you
not
do
going
that,
away. Yeah.
It's not going away, and you're going to be a victim. It's just
you really are. George, you have a fantastic group that I'm a member of, and I just love it. That's kind of the pro version that you offer. Why don't you tell us about that and give people a link where they can find out more?
Sure. So that's a partnership deal I have with Lynn Alden and Chris McIntosh. Lynn Alden is an extraordinary mind. She's a research analyst, I guess you could say. She's huge on FinTwit. And then Chris McIntosh has been a fund manager for many, many years. And they see the world in a very similar way to you and I, to say the least. So we set up this online forum for people. It's called Rebel Capitalist Pro. It has research from Lynn and Chris. We do live streams for members where they can ask myself, Chris, Lynn questions. And then the user-generated content is fantastic. And then it's just a great resource for people. But I always call it a sane space. Mm-hmm. Right? Because we have all these safe spaces at local universities. Right. Yeah. And I call this a sane space because for people like you and I, we go online You go to your Facebook feed or something like that, and it's just filled with just insanity. Yeah, whenever you go online. So this is a way for people who kind of see things the way we do to congregate, to help each other, and then to use that research to be prepared and to make more money and to not only survive but thrive in a world of out of control central banks and big government. So that's georgegammon.com /pro.
And I'm chuckling because that's George's tagline: how to survive and thrive in a world of out of control central banks. Good stuff. So the link again is georgegammon.com /pro. And that's your Rebel Capitalist Pro group.
Yeah.
Good stuff. George, hey, thanks so much for joining us.
Thanks for having me.
Happy investing.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.